Welcome to the Wealth Studying Podcast. This is episode 530. Today is August 5th, 2026. I'm your host, John Pugliano. I'm also the founder of Money Manager and InvestableWealth.com. I've got my son, Joe, in the co-pilot seat. He's our tech analyst. Joe, what are we going to talk about today?
S&P 500's at record highs.
It is at record highs. And by the way, hello, YouTube. We're live on YouTube today. S&P 500 back to record highs. We've had a bumpy year and really a bumpy 18 months or so. This is probably the most hated stock market rally I think I can ever remember. Guys like Ray Dalio, the whole host of perma bears, they always come out of the woodwork to claim we're at the record top and things are about to fall apart. Maybe they will. Sometimes those guys are right, but I'm not going to go into Ray Dalio's thoughts. If you've ever listened to the episode that talks about the 5 dumbest listener questions, then you'll know why I don't care about Ray Dalio or any of these other people, what they think. So, Joe, what's the hate? Why is everybody hating though?
Well, there's a few things, right? Inflation, and the Fed might raise rates.
Yeah, inflation. It keeps supposedly rearing its ugly head. However, we haven't had calm inflation or target inflation for 5 or 6 years. So that's nothing new. And the market has, is up more than double since all this started, since all this inflation started. So that doesn't worry me. The other thing that people never seem to get about inflation is, Joe, what is inflation?
Inflation's where the price of things rises.
Price of things rise. What happens to the price of things on the S&P 500? They rise too, right?
We're at all-time highs.
We're all-time highs. Yeah. So, to me, the most rational way to protect against inflation is to own assets that are going to go up in value. That can be gold, that can be other things, but historically, it's also good quality stocks in the S&P 500 because, and we talked about this a few episodes back, when Apple stock took a dive because the memory and the other chips and things got expensive, and they were afraid Apple couldn't pass the price increases along. Well, what happened? Right? They raised their prices. Apple raises the prices. Apple stock went on to put on a record high after that. Guess what? They dropped back down again. It's just a continual leapfrog. And yeah, this is probably the most hated rally I can ever think of. Inflation doesn't bother me, and where we're at now, it could. I'm not saying inflation doesn't. When it was 6-7%, that bothered me. When it's at 3%, whether that's above or below the Fed's target rate, I think is irrelevant. If you go back 20 years before all this happened, the Fed was below their 2% rate, and it had nothing to do with the Fed. The Fed really hasn't controlled inflation since the 80s. What's really been the determining factor on inflation since since even the early 1990s has been the geopolitical situation. Products were made a whole lot cheaper in Korea and in Taiwan and then in China than here. And that exported deflation to the United States. Those days are over. And so just as the Fed couldn't raise inflation when they wanted to, they can't lower it. And as we've talked about, they can raise rates all they want. The big debate last week was, even as of the morning of, people were saying it's 30%, it's 50%. There was no way they were going to raise rates. I just don't see how anybody could have rationally come up with a conclusion that they were going to raise rates this last time, especially when the fact that all or most of this current inflation is coming either from geopolitical issues specifically or the Straits of Hormuz in general. And the Fed can raise rates all they want. They're not going to pump any more oil out of the ground. So it just doesn't calm those things. And as I've said before, Kevin Warsh is the worst Fed chair we've ever had. one more thing about Kevin too, and I'm not picking on him. I don't dislike him any more than anybody else or any less. A year ago, what was everybody saying about the next Fed chair? Well,
he's going to cut rates.
Going to cut rates, right?
Trump's going to put someone in that will cut rates.
Trump's going to fire Powell. He hates Powell. He's going to put in his own guy. The Fed has lost independence, and Trump's going to stack the deck, and they're going to cut rates. Well, everybody forgets that who appointed Jay Powell to begin with? Trump, right? So just because you appoint someone doesn't mean you can control them. And again, that was the narrative a year ago. As soon as we got into this year, that all went away, and people started saying that Busch, who they thought would be appointed at that point, is going to raise rates because he's a hawk. And then, of course, things heated up in Iran and gas prices got high. And then they said, well, he has to raise rates. Well, again, he doesn't have to raise rates, because raising rates is not going to do anything other than hurt people. It's going to, the guy that can't afford to fill up his pickup truck today is not going to be helped if the Fed raises rates tomorrow, right? It's just going to make his life more miserable. So I doubt very seriously Kevin Busch or anybody else would raise rates in this kind of an environment.
We've gotten a few questions about stagflation from viewers.
Yeah.
Wondering when you're going to talk about that more.
Yeah, I've talked about that like maybe a year or two ago. I said I was going to do an episode on stagflation. We're still going to postpone that. I am not at all worried about it. That's why I haven't talked about it. We will get to stagflation someday, because stagflation is a real and present danger, just not to the United States. So we'll talk about that in a future episode. What else?
Yes, the next thing that people are hating about this rally is disruption in the Straits of Hormuz.
Right. Yeah, we talked about that. So the Fed can't do anything with rates. To me, again, my cynical optimism, I look on the other side of that and say, even with the Strait disrupted now for 5 months or whatever it's been, on again, off again, whether it's open or closed, or if it's mined, or if ships can get through or can't get through. Yeah, 20% of global oil passes through there. For the past 40 years, we've never interdicted in that area because we didn't want it to shut down or to become disrupted. Now we have, because we can, because the United States is a major exporter of oil. So it's actually profitable for there to be a disruption over there. I'm not so sure this isn't something we want, right? And regardless of all that, what's the price of oil today? I didn't check, but
$74.
$74, right? That is lower than the average price for the entire time. The guy that was there before the orange man is now, that guy, for the entire time he was in office, his average price was above $74, $76. So, and this is with one of the main choke points in the world being restricted, and oil was no higher than it really was. It's all nonsense.
Okay. What about the AI bubble and circular investing? Is that nonsense?
I wouldn't say it's nonsense, because again, things have an element of truth to them, and it is something people should be cautious about. But again, you have to look at the actual price of things and the actual value of things. We've talked before about companies like these hyperscalers. They have money to spend. If you go back to the .com bubble, new companies, like back then, Yahoo and CompuServe and Pets.com and even Amazon, right? They're going back to those early day companies. They didn't have profits. Most of these big companies today that are doing all this massive spending have profits. So yes, they're eating up their cash flow, and they are borrowing money against it, because as high as interest rates supposedly are, it's obviously still cheaper for them to issue bonds than it is to spend their own money on it. But they do have the profits to fund this. And we're in an arms race, literally an arms race. We won't get into all that, but we're literally in an arms race with artificial intelligence. And like any arms race you're in, whoever stops spending is the guy that loses. And it doesn't matter if you're building nuclear weapons or if you're building artificial intelligence infrastructure, you have to stay ahead of the competition. So anybody that doesn't spend is going to get hurt in the long run. These companies today, they do have the money, most of them. And I guess I'd say to that too, that the valuations, I think we mentioned this in the previous episode or one before that, valuations are reasonable. You go to the dot-com days and you had not only crazy valuations on profits that in some cases didn't even exist, but just even on earnings, right? They were paying $1,000, not on earnings, excuse me, revenue, right? They're paying $1,000 on sales, or just some crazy numbers. Today, you look at a company like NVIDIA, their valuation, I think last time we checked, it was like 16 and a half times. That's below the S&P average and less than half of what Costco is. So would you rather pay for Costco or NVIDIA? For me, I'd rather put my money in NVIDIA.
Yeah. So like you said, right, Microsoft, Meta, Google, they all have
money.
They all have the money, right? SpaceX announced earnings yesterday.
SpaceX doesn't have the money, do they?
Doesn't look like it.
Surprise, surprise. We don't want to trigger anybody, so we won't say anything about SpaceX, but SpaceX, I think, will be really compelling at about $50 or $60 if it gets that low.
And then other companies are raising money, like you said, and that includes in the crypto market, right? With MicroStrategy.
Michael Saylor seems to have found more kidneys to sell. So, even those guys are staying afloat, but they have assets. That's the difference. If you have assets or earnings, you can afford these things. And there's no doubt that AI is being used, like no doubt. Everywhere you go, either in your own personal life or any business life, you see people using some variation of it. And again, you didn't have that 25, 26 years ago because the internet was so new. It was more of a toy than it was actually a profit center for people or something that improved productivity. That eventually happened. But right now, whether it's artificial intelligence or robotics, drones, I mean, look at drone warfare. It works, right? People are investing in it because it works. And every drone, every flock camera that everybody's hating on, every data center that everyone's worried about surveillance of, they all use memory. They all use electricity. They all use copper. They all use fiber optics. These things are not going away.
I was going to say, you just tried a self-driving Tesla this week, right?
Yeah, I was going to say I recently just test drove a Tesla, but that isn't true. That Tesla drove me, right?
Yeah.
I hate the Model Y. There's almost nothing I like about the Model Y, other than full self-driving. I might buy one for that reason. That and the fact you don't have to deal with a salesman. Those are the two things I like about it. But yeah, and obviously Tesla is finally getting to the point where that's working well for them. Everybody else is eventually going to catch up, or at least try to catch up. What is that? It's all data. You need memory. You need chips. You need sensors. You need cameras. It is not going away. This is not like we're not going back to a Sears and Roebuck's catalog.
Yeah.
So yeah, are prices inflated? Yes. Is it a bubble? I don't think yet.
It is a roller coaster, though, right?
It is a roller coaster.
Every day, stocks are up and down, and volatility is just crazy.
I've been investing for over 40 years, and I don't remember a time, and I'm talking like the last 18, not just now, but the last 18 months are the most sustained daily volatile moves that I've seen in the market, I think, in 40 years. And the really interesting part is there have been other times when there are huge volatility within the indices. So, the NASDAQ will crash during the dot-com bubble, and that'll stay that way for a while. But what we're seeing now that's so unique is that on any given day, a major company can be up or down by 10 or 20 or 30%. And it's not unusual. And the reason that isn't having a big impact on the overall indices is that when Microsoft is up 20, Apple's down 15. And when Micron is up 10, then Google's down 20 or whatever. It's moving under the surface extreme levels, but it's kind of averaging itself out. And I think that's a healthy thing. It's gut wrenching for day-to-day volatility. I tell people, don't look at your portfolio on a daily basis. That's why Joe gets gray hairs over there. He watches that for people. But if you watch it on a daily basis and you get caught up in the headlines, you'll go nuts.
Yeah, so they're moving from maybe sectors, but not necessarily going to cash.
Yeah, exactly. That's a good way of putting it. Yeah, so people are going, when the memory chips are hot, everybody's buying into that, and the Korean index is going up like crazy, and everybody wants to jump on SK Hike and all these things. And then a week later, when all the hedge funds sell, those stocks all collapse, and everybody takes that money and moves it into SaaS, the SaaS companies or the banks or whatever. I'm glad you brought up SaaS. Okay, so the software as a service companies, the Adobes and Salesforce, Intuit, these companies have taken a beating the last year to 18 months because everybody thinks artificial intelligence is going to replace them. We had seen some interesting moves in the markets where on bad days, on down days, like when we were bombing Iran, those stocks would actually perform well. It's what we would call having good relative strength. And I was encouraged by that. We even went double down and bought some more of those guys in March, I guess. That petered out. But what have we been seeing lately, especially this week? And this is maybe a tell, maybe it isn't, but what are we seeing lately?
They're staying strong even when memory's going up too.
Yeah, even when the other artificial intelligence stocks are moving up, these SaaS guys are starting to do well as well. That could be an indication. Maybe the bottom was put in a couple weeks ago. We'll see. I've got a decent amount of the portfolio dedicated to those companies because I do think they had gotten oversold. So we'll see how that works out. So yeah, there has been a big rotation between sectors and between industries and companies within those sectors.
Yeah. And we sold some stock today, right?
We did, and we're not putting it back in the market though.
Right.
Something we've been doing a little differently here in the last probably 3 or 4 months. We've been raising some cash. Not that I'm worried about an AI bubble or anything, but I'm taking some profits in some places. I'm selling some losers in others. More than anything, what I'm doing is continuing to focus the overall portfolio on the core holdings, which I think are going to continue to grow. That's what I'm calling the industrial tech sector. And those industrial tech stocks are artificial intelligence directly. They're not related directly to an artificial intelligence in some ways, but they are in others because, Caterpillar or Cummins Diesel or copper mines, these are industrial companies, railroads, they're industrial companies, but they're also related to the whole boom in artificial intelligence because you need all those raw materials, to get to the electrons in the end. And it's beyond that too. We've talked about the other mega trends, the global geopolitical issues that are forcing more manufacturing in the United States, a fortress USA mentality, changing demographics. That means more automation. I think for the near foreseeable future, industrial tech is going to continue to be a growth area. And so I'm continuing to move the portfolio in that direction, but I don't buy willy-nilly. I don't want to go out and put new money into this market when it's at some record highs. I want to look for some pullbacks, either in the indices or in individual stocks. So yeah, so what did we sell today?
Yeah, I was gonna say we didn't actually say what it was. Anheuser Busch.
Yeah,
right? Which wasn't a dog. I mean,
no, it was performed extraordinarily well. Yeah, we owned it just a little more than 2 years, maybe like 25, 26 months. We bought it as it was coming out of the fiasco it had with the influencer nonsense. The stock took a real beating for about a year. I waited till things settled down. As it started to move up, we bought into it last June, and yeah, I've had some amazing profits on it. But
Two
and I
years
don't,
ago, not last June.
oh,
Right?
I'm sorry, 2 years ago, June of 2024. And I don't think it's a dog by any imagination. If you own it, I'm not telling you to sell it. It still looks like it has very reasonable valuations, good growth prospects. It just hit a multi-year high, and not a record high, because it hasn't hit its record highs going back many years. But it's put in a multi-year high, and it's also a foreign-owned company. I do prefer to own U.S. So I'm just tightening down the portfolio. And yeah, we made good money on it. We're going to park that in a money market fund and wait for the next opportunity.
Yeah. And if you sign up for our alerts, you'll get an email about that with the chart and everything.
Yeah, that hasn't gone out yet, but
Later
that will go out later today if you're part of that free email notification. So, hey, that's all I got, Joe. You got anything else?
Nope, that's all.
All right. Well, hey, until next time, as always, best returns.